There's an urgency if somebody is trying to make a decision to buy. It's a much better idea to buy now and lock the rates in now, because all of the financing we offer is fixed rate, and lock in the rates and at least have certainty around what it's going to cost to operate that piece of equipment.
Can you talk about the current economic conditions, interest rates, and inflation right now, and how it's impacting some of your customers?
Everybody in business, probably in the last 8 to 10 years, got spoiled by uncharacteristically low rates. Some businesses got used to that, and especially if they were capital intensive, they got used to the fact that, their cost of borrowing would be 3 or 4%, which
Yeah.
is way out of line with traditionally where rates have been in the last 40 years. What we're seeing now is rates, even though they've gone up about 5% the last year and a half, they're still back. They're close to where normalized rates would have been and probably should be over the long term. I'm not a fan of it, but what we're seeing is a lot of our customers are reimagining or going back to the drawing board and tweaking their business model to make sure that they can still turn a profit with the 7 or 8% cost of capital. What it also means, though, is that in the next little while, it doesn't necessarily, well, for sure, it doesn't look like rates are going to come down for the next, I would say, 2 to 3 years, maybe even 4 or longer. But rates still might continue to go up. You keep hearing it's over, and then, the Fed raises rates, and then all the regulators raise rates, which means that there's an urgency if somebody is trying to make a decision to buy. It's a much better idea to buy now and lock the rates in now, because all of the financing we offer is fixed rate. We don't recommend revolving or floating rates to anybody at this point, and lock in the rates and at least have certainty around what it's going to cost to operate that piece of equipment.
So otherwise, you're saying, get it now. Beyond that, is anyone opting to finance used instead of new, or financing fewer items than they otherwise would have because of the situation right now?
A lot of people are putting a lot more thought into whether they should make the commitment of buying something. So part of what we do is we take this huge expense or huge expenditure and turn it into a much more manageable operating expense over 48, 60, 72 months. But even with that, people are still considering, like, they're thinking a lot more about whether they actually need that piece of equipment, or they want to make that commitment to pay $2,000 each month over the next 60 months.
Mm-hmm.
We are getting some people who, they're shopping. The look to book goes down a little bit because we're looking at more deals. And then when people realize the expense of it, then sometimes they say, now's not the right time. Maybe 6 months from now is going to be the right time, or 12 months is going to be the right time. And you have to respect that. You have to respect somebody who's a business decision maker and makes the decision that, they're just not comfortable taking on that additional responsibility for their business. We are seeing more people going to used equipment, and a lot of the construction equipment that we're financing and a lot of the trucks and trailers, the transportation equipment we're financing is used equipment. So long as it's low mileage or low hours, it still has a lot of economic useful life to it. And if somebody could get that equipment to do the same job at a lower cost, then that's going to be great for the business.
Right. So looking forward the next 6 months, what do you expect demand to be during this period?
We're seeing spottiness. Our industry, everybody's a competitor and everybody is also a friend. It's a very small industry, so we talk a lot amongst ourselves and, try and find solutions for all of our customers and vendors. I would see, in the next 6 months, people are definitely going to be thinking about what they're going to do. In the US, it's a little bit more severe than it is in Canada in terms of what the portfolio performance has become. People are seeing serious softening in the quality of their portfolios. For the last 10 years, everybody in credit, made the right decision. Everybody was a genius in credit because delinquency rates and charge-off rates were at historical lows. Now they've been coming back again, normalizing back to where they traditionally have been. And a lot of the lenders are getting nervous about it. The banks typically are the first ones to decide to pull out of either an industry or an industry vertical. Decide, for instance, I don't like companies who do this. And then they call all their loans, and then they don't grant any more credit in that industry until somebody changes their mind. So in the next 6 months, as the doom and gloom becomes, hopefully it won't, but it could become a self-fulfilling prophecy, then
Right.
you're going to see tightening of credit, which makes companies who do what we do, which is, we deal with banks and pension funds, private equity money, life insurance companies to place really large deals for investment grade credits, but we also have alternative sources of funding, traditional equipment finance companies, private lenders. Companies who do what we do are going to become a lot busier as our customers and our vendor partners, on behalf of their customers, are looking for more fair terms for financing.